Just one sec. Nobody's
Oh yeah,
probably.
do your thing.
It's one of those days.
I'm like that, man. It's all good. I feel you on so many levels.
It's just one of those days. It's Occam's razor. But yeah, so where we were starting with Kevin, we've been doing a lot of reports lately, a lot of commodity stuff. This week we had the Fed. And what's been interesting with the Fed and what I kind of always think is when people trade Fed days, like it's incredibly hard to know like day one, you're like, okay, well, the Fed has said this. I know exactly what the market's going to do. Everybody buys like crazy. That's usually normal, or they sell like crazy. Fed days actually have a little bit of a bullish tint. Actually, if you back test it, it's actually over 65% of the time. Fed day, the market goes up. But what I always say is like you really don't know the general move of the market on Fed day until a couple days after. Now it's Friday. Then the market kind of looks like it's topped out a bit. Everything looks a little like it's beat up, like it's tired, like it doesn't want to run anymore at the moment, like this happens. So what usually happens to me is I'm like, I'll really kind of know something or the general market direction will go on Monday. I think we all kind of read into it so much and we think this is going to happen or this is going to happen. And really, Monday is going to tell us the most about what's going on with the market. It was really interesting, like I believe like Kevin believes we were talking. I listened to Kevin talk on Spaces the other day, and Kevin was talking about the fact that when we're looking at the Fed and people are like, oh, well, they might cut rates, they might not cut rates. I also think they might be kind of pushed into it at this point. They kind of have some other things that they have to do. But I also could see that if the Fed really wanted to put any pressure on inflation, all they have to say is that, hey, we're not going to cut rates. I think too many people are thinking in the realms of rate hike right now. And I'd be really surprised if that actually happened. Like, that would be the most mind blowing thing I think I could ever see. All they would have to do to calm down inflation is say, "Hey, we're not doing this anymore. We're not lowering rates anymore." That'd be the end of it. And then the market would probably come down, and then they'd probably end up cutting rates. So, Kevin, what are you thinking about the Fed right now and what they said this week?
Yeah, so going into this week, let me just kind of give that backdrop and then I'll give you my thoughts. So coming into this week, obviously we knew that the Fed is going to eventually cut. We know that that's going to happen, but we haven't reached our targets yet or getting close to the targets yet, in my opinion. And I think it's not surprising what Powell said in his press conference. I was pretty adamant about that. I mean, he's usually starts off very strong, if you will. Starts off like on the books, hits the notes, hits the talking points, and then as you get him to answer more questions, he becomes a little bit more lax in his answers, a little bit more dovish in his answers, and that's exactly what happened. The curveball for me for this FOMC meeting though was the statement of economic projections. It was not surprising to me as I talked on Spaces, and we kind of talked about this. I'm not surprised that they actually raised up their core inflation target. I was looking at 2.6. That's exactly how they moved it up to. But if you look at it, they didn't actually update their headline PCE number. And so they're still focused on, and this is going to sound like an obvious thing, they're still focused so much on the services inflation. And I get that, right? That's their main target. But I don't think the risk is services inflation right now. Services inflation takes a long time for it to develop, right? We'd have to have goods inflation, significant good inflation for, say, 6 months, 9 months, maybe even a year before those that are within the working population start saying, hey, I deserve more pay, which is where you get the wage increases. And the wage increases are then what sparks off the services inflation. Since services is around 70% of our economy. So I felt like they kind of discounted the goods inflation side of it. They know that they're going to see services inflation move up here a little bit. They kept their target for rate cuts at 75 bips. It just doesn't seem like it adds up to me unless they know something. I'm not trying to be a conspiracy theorist, but unless they know something that we do not, or they have a fear that we do not know, which is mostly going to be financial credit based, because that's usually how every single cycle starts, is a credit event. And I'm not trying to say like be very vague. That's exactly what happens. Something messes up in the financial markets. Either that's the case, or they gave up on on their inflation target, and they moved up their soft target to 2.5%. I think that is the case. As you said, I think they're getting bullied into this. The economic data from a headline standpoint is still fairly good from what people always talk about. If you're looking at employment, that's good right now. Let's say it's even goes up to 4.1%, that would still be historically low on a nominal basis. And then if you look at GDP growth, yeah, we might have GDP coming in at 2.3% for the first quarter. Not a big deal. You're at record high rates, at least for the last 10 years, 15 years. That's actually still fairly good. And you have people and consumers continuing to spend when you're looking at retail sales. So if you're going off of that metric before, why are you not going off that metric now is where I'm at when it comes to the Fed. And I think they're changing the goalpost. There's economic data that's really bad out there. And you look at consumer credit utilization rates, delinquency rates, net charge-offs for two of the biggest credit card companies that are out there and actually exceeding pre-COVID levels, which is not a really good thing. There's a lot to say the bottom half or the bottom third of the U.S. economy is not in good shape. Are we neglecting those individuals now because you want to appease the market in one way, shape, or form? That's where I'm at right now. What do you think?
No, I think that's great. It's once again, it's like I've watched these cycles so many times, and every time they kind of do the same thing. They're very quick to start hiking rates, and they're very slow to cut. And I think it's, there once again, there's like so many ways of looking at it. The Fed is so multifaceted. I think like you, where it's like, do I think they're just going to come out and cut them without any provocation? No, I think that there will be something out there that happens. Once again, they can kind of point to things and say, this is happening, and people will go, that's what's happening. It doesn't even have to be a real thing. It could be something that they're just thinking about, something that they just know that we don't exactly know, something that's future risk. They're going to have some form of reason, and that sort of reason is what's going to trigger the event. I think when you start to see that type of once again, the Fed usually likes to cut when we see some form of crisis. Right. Like they don't just like to cut when we're just kind of everything's doing well. Like if you were talking about a reason to cut rates today and you said, hey, the market's just trending up, commodities are all melting up, cocoa's at all-time highs every single day. Like we have all these kind of melt up scenarios, and you say the Fed's going to cut rates. It sounds kind of crazy. It's the reason why you would think they would hike rates. However, the market's forward-looking. The Fed's also forward-looking. It's March. People are talking about this happening later in the year. I think this absolutely could happen later in the year. As soon as June, I'd be surprised. Once again, there's so many different ways of looking at it. I think the most important thing for me is like, you got to keep an open mind of all the ways this could go. I think there's a high probability that they just don't do anything. I think there's also a high probability that they cut once or twice even. And being open to that, the market has been trading like they're cutting rates. So we need to continue to trade the market like whatever people are looking at the market, because that's what's driving the price action. The trends are up. The commodities continued to rage that day. I think that was really like significant when he looked at the market after hours.
Oh my God.
Yeah.
I was like
6
fishing.
p.m. last night or on a Wednesday night. Yeah.
I was out fishing, right? And I'm like, all right, let's see what's going on. Palladium, 4.3%. Soybeans, 2.2%. It was just craziness. But you know what did not catch a bid at all that night? Treasuries. And that's a sign for me that says, hey, if this is peak rates and we're going to have this rah-rah session, all right, if that's what the Fed wants, that's what the market wants, we trade whatever the market wants. You want to neglect a particular scenario, or you want to neglect a situation, I'm cool with that. You tell me the rules of the game, I'm going to play ball with you. That night I was like astonished. It was like the short squeezes of all short squeezes, especially for the metals. Like platinum was up like 2%, 2.3%. It was crazy to say the least. And I don't mean to cut you off, but let's just game this out here real quick. We have 6 more meetings left, right? May we don't cut. Okay. June, let's say we don't cut. And I think June could happen, but let's say we don't. Let's say we get another hot inflation print and they neglect. Remember, we got 3 on the board, and it's not sad policy, right? But they wouldn't update the SAP to turn around 60 days later. Any type of situation like that would be, once again, an event that would be. You still got me?
Yeah.
Yeah. Any event, any cut. Let me see this. You wouldn't put out 3 cuts to then adjust that complete policy in the next 60 days. That's the next meeting, right? Is in May. So you don't cut in May, you don't cut in June. That gives you 4 meetings left for 3 cuts. You have the November meeting that is literally the day after the election, if I'm not mistaken, the 6th. So, and they're not going to cut. That's craziness, right? Like they wouldn't cut on that meeting. It's on that Wednesday. Would they cut the day after election, 2 days after election, which we probably won't even have a decision? They're probably not going to do that. So they're stuck at July to start, in my opinion. Or they start in September, they skip November and do December, and you only do 50 basis points. The timetable right now is not conducive for the Fed unless they start cutting very early. And that's where I feel like Jerome Powell can get away with it, because he can say, okay, yeah, the data's looking decent, great. He can get ahead of it and start cutting before inflation really starts to rise again, if this reflation trade is a thing. And I think he's going to say, well, the ship has sailed. Let's go ahead and do it. I'm sorry. Let me also bring up another thing, and I'm not trying to be a conspiracy theorist. There is another scenario where they could cut rates. And unfortunately, what's happening right now in Russia, with the attacks that are occurring, that is happening right now. One, that's a geopolitical risk event over the weekend. So like, be mindful of that. If you're holding any type of energy product, like energy trades, beans, anything that's grains related, just know that you have heightened geopolitical risk right now, because Russia's already blaming Ukraine and they're already kind of pointing the fingers at the US. Let's say the Fed did know that geopolitical tensions were going to escalate and maybe get kinetic. I'm not saying directly between the US and Russia, but maybe the escalation within maybe Poland or Moldova and Belarus or what have you. And maybe they are like, hey, there might be something down the line here where we need to cut right now because the war shock could be eventful. Once again, that's just a theory. That's the only one that I can really justify. I was thinking about that last night. It's the only one I can really justify with the data that we have for the reason for them to do the cut.
No, I like that. I mean, it's like we say, there's so many things that could go into this. And I think we all kind of, especially people on Twitter in general, are kind of like trying to dice it down to something. But I think the conversation that we're having is important, because we're talking about the different ways it could happen. Because that's markets, right? We don't know anything for sure. The one thing we do know, they will cut rates at some point. We know that is coming. We don't know when. We can't exactly time that. We can't exactly see what inflation will look like with each report and so on going into the future. We can watch the price action. And like Kevin and I were talking at the beginning of the year, talking about, hey, like some of this price action is significant because it is going to weigh on CPI and PCE. And so if this does start to weigh on these things, that is going to put some pressure on the Fed. Now, once again, they're trying to play it off like it's nothing. And really, if you're looking under the surface at inflation, like I am all the time, I'm a commodities trader. I'm seeing the moves here. I'm seeing that they are kind of going to go, they're getting a little bit painful at a certain point. Are they there yet? No, they're nowhere near it. Somebody said to me the other day, and it was not a dumb thing to say, it was a very good thing to say, which was, when we could have a couple, reports that are lower inflation, and then next thing you know, they're cutting rates again. It's like, yes, but where do they get the numbers for PCE and CPI? Well, they get them from the commodities market. So if we continue to see higher prices in the commodities, obviously oil is something you really have to pay attention to. Then obviously that's going to make those indexes rise, and then the Fed's going to have to do something about it. So once again, are they going to just continue to do what they did in 2020 and say it's transitory? I would be very surprised. Like, I don't think they're that dumb. I don't think they'd make that same mistake again. It obviously got completely out of control by doing that. I think most people are always fighting the last war. And because they're fighting the last war, they're going to be very interested in putting an end to this quickly. And how do they end it quickly? Well, it would be to say, like they did for so long, people are quickly forget the last couple of years. They've been going on and saying, "Hey, well, the Fed, we're not going to be in a rush to cut rates. We're not going to stop raising rates. Inflation is here. We need to take care of it." Like, I don't think they're going to completely shift and go the other direction very quickly. And then I don't think they're going to stick to this, hey, this is a bump in the road type of thing. It is at the moment. I'm also not saying like, hey, we have this insane inflation. It's out of control. Who knows what's going to happen? I'm not saying that at all. I'm saying it is a bump in the road at the moment, but it's a lot of base breakouts, which usually lead to trends. And so if those trends continue and persist, that's going to put pressure on it. Now, will they have the ability to just go, hey, it is transitory and make the mistake all over again? Absolutely. And honestly, as a commodities trader, that's what I've been kind of betting on, is that they will most likely get behind the curve, because the Fed is very famous for getting behind the curve and letting things get a little bit out of control, up or down. Yeah. So right now, I'm just kind of waiting on it either way. Our positions are very long on the commodities markets, and we'll see where it ends up.
Yeah, I would say, and I'm right there with you. Look, if we had a scenario right now, so let's game theory this out. Do you want an economic downturn, or would you rather have higher inflation? I mean, there's an easy answer there. The problem that you have is, do we have everything in place right now to make sure that transition, that soft landing is going to be there? Are we calling this a soft landing? Are we saying mission accomplished? You can say that if you're going to move your target up. And if they had language that said, hey, you know what, we believe that the market is going to be able to tolerate the current rate and trajectory of where inflation is right now for the time being, until the market continues to mature over time. If they came out and said that, fine, it's understandable. What I don't understand is that you've been harping for the last year and a half about getting this thing down. You get to the last mile, you know that you can't get this darn thing down, and so you're giving up on it. And I know people are going to push back like, yeah, we're there at the last mile. Think about this. Does anybody think that our housing supply issue has gotten fixed, even though we have 6.5% interest rates on mortgages, right? Yeah. Look at the home building stocks. Complete disconnect from any traditional type of market when a higher interest rate environment. The reason being is because they don't have any existing homes on the market. They're forcing people to get into new homes or not to get into homes at all and renting. And that's the crux of the issue here. 40%, 30 to 35% of inflation is shelter in one way, shape, or form, right? You never even fix the shelter situation. So then let's take the other 20%, 25% of energy, and we're in February, y'all. February and March of last year, if you look at the retail AAA gas, that was actually, for the most part, the peaks. We're already at those peak levels. So if we keep going on that trend with significantly less demand from consumers, we keep going on that trend, prices will go higher. That month-over-month comp is going to continue to pressure higher. So then what? So that's kind of where I'm at. Now, if we talk about the strategic maneuvers that you can do within the trade, I think you're right there. I think energy, and hear me out, because you are seeing a little bit of a pullback with crude. Something's brewing in China with that currency move last night, and I don't know what's going on. And I know that there's an issue with Evergrande, and they're kind of looking at another company that could have been a part of this whole fraud scheme and all that stuff. That currency move to the downside when you're looking at the yen is not a good sign, to say the least. That's why we're seeing crude move to the downside. There's rumblings and cracks in that market. Gold continuing to move up. So I think that that's where the pressure is coming from for crude. And in the energy play, look, we could range out between $80 to $85 throughout the whole summer. And I think that's still going to provide you the inflationary pressure. And that's still going to be a nice range bound trade. Not providing any type of recommendation. I think that there is a potential grain trade out there. And it's very risky. And you and I talk about this all the time. There's a lot of supply right now, but Brazil is having issues with harvest in certain respects, and it seems like they're having some issues with crops being too wet and getting disease. So there could be a grain trade that's out there. Game theory this out. If there is a soybean trade out there, if there is grains just as a whole, maybe X wheat, even though wheat might be popping right now based on what's going on, nothing can bring that down during the summer months. You and I know that. You won't be able to do anything until harvest because you have weather risk and all that stuff. Okay, you got a grain trade. If that's not the case for grains are going to be one of the biggest deflationary factors in this market. Let's say that we have the production targets coming in well above expectations and things turn around for Brazil and for Argentina. We're going to have a flood of supply. We already have a whole bunch of inventory within silos right now. We would see literally a crash within the soybean market and the corn market. So I understand that risk that's out there. I just don't think that that's going to be one. And then you already talked about livestock. Livestock's going to be weird though, man, because if you look at it from a chart standpoint, you kind of want to fade hogs and you kind of want to fade cattle all day, right? Like your fingers just itching to press that button. But you know that the underlying supply issues that are out there are not going to abate anytime soon. So everybody's kind of like looking around and saying, okay, what do we do next? And then I think metals. In metals, you kind of talked about that too. The short squeeze possibilities in metal right now and the short positioning that's in metals, and we do have a reflationary trade that comes out, will rip people's faces off. I think silver was up 4% overnight that one night, right?
Yeah.
Palladium, platinum, all those are still short. Those are heavy shorted positions.
Heavily.
Copper, for the most part, starting to get a little bit long, but you still have some opportunities there. So there's a lot from a market structure standpoint that could actually provide a boost to the upside here. That's all I'm kind of trying to say.
No, for sure. It's literally across the board, right? And that's the thing that I think people aren't really looking at in the commodity space. Like, number one, like all the people like to think like, okay, the market goes in this very normal way. And when we have things like inflation, commodities go up and so on. It's like when nobody was talking about inflation, this is when the inflation trade was its best. Nobody was talking about it in 2020. You were stupid if you brought up the fact that anything could go up in the commodities market because it's gotten beat to crap for so many years.
You were calling us stupid in January. We were stupid 60 days ago. Now look at it.
We had a whole thing where people, like, somebody said I was calling for a market crash because I said inflation was possibly ticking up again. It's just market. Nothing goes straight up or straight down. And that's the normal way to look at markets. And number two is when nobody's looking at something and everybody's saying that's not happening, that's usually when you should pay attention to it. Like Kevin brought up, you know, these areas where there are uptrends in many things across the board. You know, you have cattle uptrend, you have hogs, it's in an uptrend, a huge gap up. You know, we're running into an actual crazy seasonal period in lean hogs that's going to start right in April. And it's already in an uptrend. And then it finally broke out from another range bound flag pattern. Like, it's just continuing. Lumber, it made a huge base and then it broke out of that base. It's starting to move too. All of these things matter. And they matter to the commodity cycle. And so we're going to see these things continue. And if they're going to continue, and even things like corn, you know, corn it moved off its low and now it's consolidating. If it made a higher low, it would actually give us a pattern buy signal. Like, all of these things are just kind of screaming, hey, this is starting to happen while everybody's saying it isn't. That's honestly when the best trades happen, when everybody's going, this is impossible, but it's happening. And it's the same thing like cocoa. Like, until people stop trying to short the thing and stop trying to say how ridiculous this trade is, it's just going to continue. I have no idea when it stops. I would love to have tons of conversations and speculation about it, but it's way beyond any fundamentals, technicals, any sort of reason, positioning you could dream of. It just continues. So, you know, I think the overall, what we're saying more than anything else is continue to look at these areas, continue to look at those reflationary sectors. There's a lot of value there, and there's something to buy instead of trying to do the same thing over and over again, like buy more tech stocks. It's been a great trade. maybe
Yeah.
it continues, maybe it doesn't, but there's areas where there's value that's outside of that.
Yeah, for sure. Can you imagine, or when, it's not even an if, well, it might be an if, maybe cocoa never comes down because there's a structural issue there. Maybe that's the case. Well, let's say in the next 3 years it's going to be an issue. All right, let's just say, let's game this out, dude. Imagine, because that thing limit up and limit down, it doesn't have like free open range when it comes to its price. So you can have these gap up and gap down markets and locked up markets. Can you imagine the unwind of that trade? Like when it does happen, or if it does happen, that's going to be epic, man. It's going to be crazy. You're just going to see these gaps, just like people just trying to get out. But I'm right
Oh,
there with you. You can't fade it yet. You can't
yeah.
fade it, and you know that you're going up into a season where it's in high demand, so you can't fade that. So, but it's I'm right there with you, man. It's that's like I said, live. You can look at live cattle right now. Every technical level for me is like, dude, fade this.
Mm-hmm.
But then you go back and say, okay, well, hundreds of thousands of cattle just died in Texas.
Yeah.
Like you can't, that the USDA cut prices literally every day continue to rise for pretty much every type of cut that's out there. Ground beef, if you're looking at retail prices for ground beef, it's like $5, $5.50 a pound. Like that's crazy to say the least. But yeah, you can't fade it. Yeah, can't fade it.
I mean, it's the cocoa trade over and over again for me, which is kind of signifies like what I do more than anything else, which is like sometimes there's these very thin markets where you get great trends in.
Yeah.
Lumber was one of them. You if you're trading like I am in my time frame and you're sizing small enough, you're sitting there and able to hold on to these major trends. And yes, there's going to be limit ups and limit downs, and it's going to be a mess sometimes. However, I have never had one of those trades happen where it's like not breaking a significant level and then the gap downs happen. For example, cocoa in this massive uptrend, it will break down at some point. However, it's not just going to go straight up and then just start crashing right down over and over again. It's going to go sideways, and all of a sudden you're going to see a lot of volume trying to push it to new highs, and it's not going to go anywhere. That's going to be the biggest signal you're going to get. That's going to say, hey, it's probably the trend is probably over here. And most of the time, those don't usually happen. You don't get those major breakdowns until you really get those sell signals. Too many people just hold on to things as they're crashing and are like, oh, it's gonna continue. It'll go right back up. Like no, that once that thing's done, it's done.
Yeah, and if you because I kind of probably freaked out a couple people. So yeah, it can go limit up, it can go limit down, right? One way that you can actually structure, especially if you're a longer term trader like yourself, you hold a futures position for a month, 2 months, 3 months, or what have you, right? Continuing to roll. You could also, when you have those gap up or gap downs, you can also sell deep in the money call. Like if you're long, right? You can sell a super deep in the money call to spread yourself out, even if you weren't able to get out, and then just wait for that expiration to be able to offset that position. That's a way that people can structure it to get out. So even sometimes those thin markets, you can do some finessing to make sure that you can lock in your profits, even if you do have the situation where there's no buyers out there and it's just all sellers. So
you're saying a good thing though. But you're saying a good thing though, because there's people who get into these markets and they don't understand those things. I had a friend years ago I trade lumber. I always tell people lumber is extremely thin. It's probably one of the hardest markets to trade. Now that they changed them to the LBR contracts, they're a little bit better. But when they were the LB, they were super thin.
Yeah.
And so I had a friend try to buy them when they were the LB, and basically he just got stuck. And like it was limit down against him. He took a huge position. It was just the opposite of anything you would want to do in that market. So, you have to understand if there is if there's not a bunch of liquidity, you can get blasted. So, stay away from markets like that if you don't have the capital to really understand. Because what I do, we'll end on this. I know you got to go.
Oh, yeah, no, I'm looking at what Natty's doing. So go ahead.
Okay, cool. When there's limit down days on something like lumber, I will go and count what is the most limit down days that lumber has ever had. And when I do that, then I will size my position accordingly if I got caught in like 5 limit down days. Yeah. I think that's really important because you always have to figure out like what's what are you risking? And when you're in something that can go limit down days for 5 days in a row, that's what you're risking. That's the biggest
Yeah.
risk there is. Like that's what you're risking, though.
I'm right there. Yeah, man. I mean, once again, we usually talk about about the commodity space, so I'll kick it there. Once again, there's a lot of opportunities that are out there, like you're talking about, and even if you're looking at some of these stocks that are related to these commodities, potentially some of them have some decent opportunities, right? Just be careful. I talked about it on Spaces with the refiners the other day. The price action looks great for the refiners. Cool. Ride that bad boy until you have earnings, because the earnings are not going to match. And we actually did see a downgrade for Valero today. We did see that stock pull back. So just kind of be mindful, ride those trends, but also understand when things can be a little bit overvalued. I'll leave it with this, man. I'm keeping my eye out on natural gas for the weekend. That's what I'm looking at. I'm looking at natural gas and I'm looking at oil. If something does come of this particular situation, which once again I feel is unfortunate, just innocent people even losing lives, I don't like that. But this is one of those type of geopolitical catalysts that you can have where we do create a potential super cycle that could actually impact a significant portion of the globe, especially when you're looking at Europe. Yeah, we're in the about to go into injection season in the next month, right? Europe has a fair amount of inventory when it comes to natural gas, but they also increased their natural gas imports from Russia by like 20% this time basically in January compared to what we saw last year. They're still relying on them, and that's still a lever that's out there. That could be something that could be at risk. I'm not providing any advice. I'm just saying that's something I'm keeping my eye on. I appreciate you, man.
No, it's been great to have you on, Kevin. Maybe we won't be so busy next week. We can get a little bit more time. This was a lot of fun, man. As always, just have a lot of fun chatting with you, man. And we also have some other stuff off topic, off of this stuff that I want to talk to you about next week. So let's make sure to talk next week. We'll get on a call and we'll talk soon, man.
Sounds good. Hey, you have a good week, Evan.
Hey, you too, Kevin.